All right, today we're going to dig into the investment case for NetEase. Now, this is one of the biggest, most powerful gaming companies on the planet. And based on a really deep dive analysis, we're going to explore why this tech giant might just be one of the most compelling opportunities out there for investors right now. This single line from the research report, it just nails it. It perfectly captures the entire thesis we're about to unpack. The idea is that there's a huge disconnect between how well the company is doing and what its stock price is saying. So here's how we're going to break it all down. First, we'll lay out the main investment thesis. Then we'll pop the hood and look at the core business engine. After that, we'll get into the really exciting part, the global growth story. And finally, we'll square up the risks against the potential rewards. Okay, let's jump in. So let's get right to the bottom line. Why does the analysis land on a firm buy recommendation? Well, it all comes down to a classic case of the market, maybe not seeing things clearly. The big idea here is that investors seem to be way too focused on the risks associated with China. And because of that hyper-focus, they're missing the bigger picture. They're just not giving NetEase enough credit for its rock-solid fundamentals and, maybe most importantly, its absolutely massive growth potential outside of China. And that disconnect, that creates an opportunity. The report points to four major things, four catalysts that could make the market wake up and reevaluate the stock. First, its push into international markets is already working. Second, things in China on the regulatory front are starting to calm down and become more predictable. Third, their existing games are just these incredible, durable cash printing machines. And all of that, together, should lead to the big one, the shrinking of that China discount. But before we go any further, to really get why this thesis holds so much weight, you've got to understand the incredible strength of the business itself. It is a beast. Just look at this revenue breakdown. Gaming isn't just part of the business. At almost 82% of revenue, it is the absolute undisputed engine driving this whole company. And we're not just talking about any old revenue. This is high-margin, sticky, recurring revenue from a model they have absolutely perfected. And here's what that engine produces. A balance sheet that is just a fortress. We're talking nearly $20 billion in net cash. Now, for an investor, that is just huge. It's a massive war chest they can use to fund new games, snap up other companies, and give money back to shareholders with dividends and buybacks, all without needing to borrow a dime. But how in the world did they build this financial fortress? The secret sauce, their biggest competitive advantage, their moat, is a world-class in-house R&D machine. See, unlike a lot of competitors who just license games from others, NetEase builds its own blockbusters. That means they own the IP, they create these original, long-lasting franchises, they keep all the profits, and they have total creative control. Okay, so now we get to the most exciting part of this whole story. Let's see how this incredible R&D engine is fueling a strategic pivot that's turning NetEase from a domestic champion into a true global powerhouse. What's so fascinating here is how they turned a massive challenge into a game-changing opportunity. The pivot really began back in 2019, but it was the regulatory crackdown in China in 2021 that lit a fire under them. It forced them to hit the accelerator on their global strategy. And now they're aggressively opening studios and snatching up top talent in the US, Canada, and Japan, with this huge goal of getting half their gaming revenue from outside China. And hey, this isn't just some vague plan for the future. It is happening right now. They're already launching hit games on the platforms that Western gamers love: Xbox, PlayStation, PC. You've got titles like Fragpunk and the super hyped up Marvel Rivals that are just concrete proof that this global strategy isn't just talk, it's working. Okay, so we've seen the financial strength, we've seen the growth story. Now it's time to tackle the elephant in the room, the risk. And more importantly, why that risk is the very thing that creates this whole investment opportunity. The entire valuation story really boils down to this one simple question. You hear this term thrown around a lot, but what exactly is the China discount that's holding the stock price down? Simply put, it's a penalty. Investors get nervous about the risks of investing in China. Unpredictable regulations, corporate structures that can be hard to understand, geopolitical friction. So what do? They demand a lower price for Chinese stocks compared to their peers in the US or Europe, even if the company itself is firing on all cylinders. And wow, this chart shows you the real-world impact of that penalty. NetEase trades at a price-to-earnings multiple of around 16.6 times. Now, compare that to its US counterparts, which are trading at 25 to 30 times earnings. That is a massive, massive gap, especially for a company with the kind of growth and profitability NetEase has. The discount is real, and it is deep. So the big question is, how do they close that gap? Well, the path forward is actually pretty clear and logical. As they keep executing that global strategy we talked about, more and more of their revenue comes from outside China. That de-risks their earnings, right? It makes them less vulnerable to the whims of any single country's regulations. And that, in turn, should convince the market that NetEase deserves a much higher valuation, one that's more in line with its global peers. And look, management isn't just sitting around hoping this happens. They have a clear, proactive game plan. The number one risk, Chinese regulation? The answer is geographic diversification through global expansion. The risk of being a hit-driven business? They mitigate that with a diverse portfolio of evergreen franchises. They are actively tackling the very risks that created the discount in the first place. So let's just bring it all home. What this analysis is really telling us is that you have a company that is financially bulletproof, an absolute best-in-class operator with a clear and working plan for global growth, and yet it's trading at a price that just doesn't seem to reflect any of that underlying strength. And that leaves us with one final provocative question to think about. As NetEase becomes more and more of a global company, and as things in its home market start to stabilize, you have to wonder, at what point does that perceived risk, that China discount, flip on its head and become the very reason it's a China opportunity?